Great. So I want to start out the conversation by kind of referencing how the last conversation ended. One of the panelists mentioned that fund size is the enemy of returns. And over the past year or so, we've seen some of the largest funds close in history. For example, KKR just closed a $9.3 billion Asia-focused PE fund. So, what is really driving that if the saying is true that fund size is the enemy of returns?
Start here?
Sure.
Start here?
Yeah.
Yeah, well, I think that's true. But I think it's inevitable. If you look at the size of the equity commitment checks that the large pensions have to write to the sector, I mean, we're talking $100 million, $200 million checks in some cases to some of these funds. So I think there is still going to be a proliferation of those very large fund sizes. That said, we don't play in that area. Our sweet spot is really sort of $250 million to $750 million, but it becomes challenging then to deploy capital at those stages. Right. So I think I think it is going to be an ongoing. I think the flip side, the half glass full, is that we are seeing a lot of funds spinning out, some folks spinning out of these funds and setting up. They've got great credentials and they're setting up smaller funds, and I think you maybe can take advantage of that.
Yeah, I would agree that the private equity market, like the hedge fund market, is bifurcated. You have the large global firms. I think last year, 2016, 38% of the capital in private equity went to the top 20 firms. Sam, as most of you know, goes the opposite way of the crowd. So we're focused on smaller entrepreneurial firms from 100 million to 500 million, and we'll do first-time funds or emerging manager funds, and like the specialists, where we think that the trends of innovation and institutionalization make those managers more risk-aware, and they're more capable of generating alpha.
Now, I just want to interject. Is this are we in the midst of a shift away from these colossal funds in favor of newer LPs, not necessarily newer, but earlier in their life cycle, more niche strategies, or is this really a AUM versus check size debate?
I mean, I was just going to say, I think private equity isn't one size fits all, right? I mean, different investors have different objectives, different constituents that they're investing on behalf of. Just like you wouldn't want to have a full complement of managers wearing dress shoes versus sneakers. I think you gotta mix it up a little bit, and I think there are also just structural and tactical reasons why it's really hard to see a major shift. I think Dale mentioned it, but the biggest allocators of private equity have limits on their ability to participate in smaller funds. So I think that in and of itself makes it tougher. But then just tactically, I think it's really hard to make a decision based on macro factors today and allocate to a manager today that's going to invest that money over 4 or 5 years and then harvest those investments over 5 to 10 years. So I think it's, private equity doesn't necessarily lend itself to the same sort of tactical movements that maybe you might see in the more liquid public markets.
Yeah, I don't think it's an either or. I mean, it's a massive space, and it's only becoming bigger, and it's becoming bigger because it's the best performing asset class, and folks that have been in it for a while are staying in it and perhaps getting bigger, and folks that haven't been in it are coming into it. So there needs to be a home for these dollars. I also think that it's being portrayed somewhat as, oh, we don't do big funds, or we can only do big funds because of the check. I mean, I think we're forced, at least in our organization, to look at the complete universe. And what we actually find is, yes, maybe that fund size can be something that detracts from returns down the road as the fund gets larger, but not every large fund shows those characteristics, and it's our responsibility to find those occasional funds where actually being the largest is an advantage, because it creates a moat, and you can't do, for example, on the PE side, maybe some of the most complex carve-outs, which require billions and billions of dollars just to get that subsidiary, but then just a lot of work, which can't be done by the smaller firms, for example. So I think that at least we have the philosophy in our shop that there's no absolutes, and if you're only coming forward with small funds, then you should have done the work to see that that's the best opportunity set. And I think fortunate for us, the AUM allows us to do that. We have the ability to do a check size that can work for some of the biggest funds and can work for some of the smallest funds. I realize not everyone is in that spot, but I think that there are groups, and you could look through some of the numbers, where the largest funds, at least their historical funds, which are often not as large as the fund that they're currently raising, have done very good and have outperformed some of the other funds that you might have otherwise been thinking to do.
Right. And also, the average fund life has grown longer and longer over the past decade or so. Is that a subset of an inability to create exits, or is it something else? And what are the implications for institutional investors with longer fund lives?
Well, I think on the fund life side, I mean, you have a lot of examples now of funds that had the standard life size, and now they're outliving their initially anticipated life, and there's a whole host of issues in terms of that, and sort of a cottage industry has grown up around recapitalizing these funds and resetting the carry and re-incentivizing the GP, and that could be a separate panel discussion. But you're also having new funds that are even realizing that those initial fund lives perhaps might have been a little too short, and are coming up with documentation changes where they're going out with 15 years, in some cases longer than that, or they're making it even easier and more at the discretion of the GP to extend the fund's life. There's a variety of reasons for that to happen, but I think that there's now been a longer history of private equity to show that if you're putting together a portfolio of 15 to 20 companies, you're not going to necessarily invest evenly, grow them evenly, and exit evenly, and it's not going to be the bulk of the portfolio, but there's always going to be a couple of companies that linger. I mean, we have a sort of a page-burning event when a fund actually closes its life, and we don't have too many of those, despite having a lot of funds.
Go ahead.
No, I think there's a couple things too. I think if you're a value investor too, I think you've also seen lately, because of valuations, you've seen a slower deployment of capital. So I think that's going to feed into the fund life as well. I mean, we're seeing extensions of investment periods and the like of that. But I think also sometimes we're the victim. GPs are sometimes the victim of LPs in putting these kind of 10-year timeframes on them. Because some of us, if you're an endowment foundation or an investor like us, the 10-year doesn't necessarily really matter to us. We'd rather see them do longer. And we tend to do a lot of buy and builds, which by virtue of that strategy, they take a lot longer. So I think there's some kind of a false that we put on it. But at the same time, too, it's also opening up secondary opportunities for us, where we can pick up some late stage, late life pieces of good companies where you just have tired investors that need to get out.
Yeah, go ahead, sorry.
Yeah, I think it's the asset class of private equity. It has a sort of its life of its own. We see it from the direct side as an LP and a GP, so we're going to be strategic and go alongside with our long-term partners. My brother would tell you, he's in emerging markets, they do a lot of work institutionalizing, putting in internal controls, governance, and growing the business. And then just when everything's working, you have to sell it. So he would love to have some kind of permanent vehicle, and he's working with his LP partners to try to figure out that Rubik's Cube.
I think duration expectations also have to be a little bit dynamic, just based on market and how investors are generating the return, whether it's through leverage or engineering of the capital structure or real fundamental improvement in the companies, because of different time horizons. But one nice thing for secondary investors is that when durations either extend or shorten, when there's that period of sort of change in duration, you tend to see more private equity sellers, you tend to see more groups seeking liquidity in the secondary market. And one really interesting development that we're seeing right now is just in the same way that the LP secondary market evolved from a market initially for distressed LPs to get liquid, and then migrated to more of a portfolio management tool. You're seeing a similar evolution in the way GPs are accessing the secondary market. So, initially it was distressed GPs who probably didn't really have a lifeline to raise new capital. and teamed up with secondary buyers to recapitalize themselves, reset their carry. You're now seeing a migration to really good, high-quality, going concern GPs who are raising new funds, looking at ways to provide a structural liquidity option for LPs, either at the tail end of the life or now even earlier in the life. One source of pressure on duration, I think a little bit artificial that we see, is when GPs go out to raise capital, there's an expectation from the legacy LPs that they're going to have received a certain amount of liquidity back from the prior fund. And what that can cause is GPs to sell their best performing assets arguably prematurely and giving up some of the return that their investors should have captured. And so now you're seeing really creative GPs thinking about ways to generate liquidity and retain the upside in those best performing assets. So I think it's going to be a dynamic part of the private equity ecosystem.
And as LPs, have you seen the secondary markets become more important to your overall portfolios over time due to these circumstances?
I think to the comment just made, I mean, it's become a tool.
Right.
So, the more tools you have, the more chance that you're going to use those tools on occasion. And I think that's an important thing as the markets become, broader, less stigmatized. People feel more comfortable to do it. It's just become a normal way to optimize the portfolio. And I think there's going to be constant innovation on that side of things, but it just allows you to take something that's very liquid and that you don't have that much control over in terms of liquidity and structuring and molding and along the edges do something about that more frequently.
Yeah, we would use the secondary market opportunistically. So we've sold certain positions that are non-core. And then on the investing side, look for inefficiency in the market. So we have a manager that's trafficking in small tickets and less well-known brands and buying at 30% discounts because of weakness on the seller side.
Right. And, actually, let's shift gears. So co-investments and direct investments have become an increasingly important tool that LPs have added to their toolbox as well. Is that a trend that we can expect to see continue, or is it more a flavor of the month as LPs look to reduce fees?
I think there's a subset of large LPs out there that actually only do fund investments to get to the co-investments. Mm-hmm. That's their whole. So I think that's a kind of consistent. I mean, it's the large, sovereign wealth funds, a lot of the large Canadian plans. That's kind of their strategy. I think for us, and we do occasional co-investments. We have a co-investment fund that we invested in. I think it is kind of a permanent aspect of the market. I think the one challenge is just staffing because it does take time. In a way, it's almost a different skill set. So we tend to do co-investments alongside of our sector specialist managers. We also use, we've kind of developed a strategy in Europe where we partnered with an asset manager. We wanted to get into some smaller, mid-sized European managers that we really couldn't get capacity with, mm-hmm. But they're getting us into some co-investments with them. So it's giving us an opportunity to sort of get introductions to managers. So we're using it in that way. But I think co-investments are probably here to stay.
I think to do it well, first of all, you have to have the setup and mm-hmm. the infrastructure. Now, that's fine for the handful of organizations, global organizations that do, and they're very aggressive and growing, and I think they will continue to be there, and others will have to make the hard decision. Do we take that budgetary step to build that team to do that? I think where the big problem is where everyone's sort of putting up their hand that they're interested in co-invest. And it's just very frustrating in a lot of ways to GPs because now 75% of their LPs are on that co-invest list. But even more so, besides getting notified of the co-invest opportunity, there's even fewer that will give sort of that quick no, and it becomes sort of a maybe. And I think that I think the next generation of where this is evolving to with a couple of the GPs that are furthest along on this is looking at having a co-investment fund to deal with some of the issues of sort of timing and full discretion and full capabilities. So it's a way for LPs to take some advantage of the co-investment landscape and the benefits in terms of economics that go along with that, but not necessarily having to have it all come back to them. Yeah. And I think that might be a compromise vehicle, which you see a little bit more and more down the road.
We just recently went into 2 funds that were set up that way. They have a main fund, then alongside of it they have a co-invest vehicle. In the one instance, if you want to do it, you can do 50% of your initial commitment you can do via the co-invest. So that does give you exposure so that you're not necessarily pushed aside by the larger investors who typically get the first call. And we just did another one in the UK where it's the same thing. It's an 80-20. But you also get advantage of the fees. So you get the main, the 2 and 20 or whatever it is on the main fund, and then you get advantaged fees, so you can sort of blend down the cost a bit.
Is the co-invest fund discretionary?
The one fund actually has 3 strategies. So the main fund, co-invest fund will get a piece of every deal, and then there's an overflow co-invest fund.
Okay.
There's a host of allocation potential fund conflicts, and it does cause a lot of brain damage to just figure out who gets what and how it's done, and you're dealing with different funds and different LPACs, same GP, and obviously there's economic advantage for the GP to have more money go to the main, more of the investment go to the main fund because it could potentially mean more to them. So all that has to be worked out, but if they're more apt to commit, I think, to fairer allocation policies if they've experienced the frustration of trying to round up the co-investment dollars in a short period of time, because the worst thing is to expect or need the money to be there and it's not there in the time that's needed.
Yeah, I like the comment that I think David made this morning about if everybody wants co-investments, but he was saying you have to do an efficient frontier of your internal resources, and I don't think people go through that math. They just say, hey, let's do this. Everybody's doing it, kind of thing.
I think, just from a secondary perspective, we're always sort of the grim reaper on these panels, hoping for, disruption. But when we see co-invest demand increase, and I would agree with Dale, there are certain groups that are really set up to do it well, and they do it consistently. And then there are ways to do it alongside the GP, where you're basically participating in your pro rata. But where we see groups sort of stepping in to the co-invest or direct investment arena where they haven't necessarily been that active before, and that becomes sort of more of a broad-based strategy, to us that signals a little bit of a, maybe a peaky element to the market where groups feel like there's return on the ground and all they have to do is go out and pick it up. So for us at least, it maybe a little bit different tack, but it does indicate maybe some, some exuberance about the market.